What is up, YouTube? Matt McKeever here, and we've got Josh and Ehren again back here joining us from the Findlay Mortgage Team, and today we're going to be talking about everything to do with mortgage down payments. Everything to do with mortgage down payments. We're going to really try and answer all the questions we've got over the last couple of years when it comes to mortgage down payments, because I know that every real estate investor essentially is always trying to figure out how to do more with less, right? And usually one of the biggest less parts of their financial equation is looking at their funds for down payments, right?
Yeah, down payment always comes up. Probably usually at the start of our conversations. How much do I need? How do I get it? What's the best way to do it? And there's so many different ways to be able to get into a deal that it's not really a very generalized answer, because there's a ton of different types of assets you can buy, banks you can use to close on it. So we wanted to break down type of financing you can get based off of how you're going to essentially source your down payment. So eventually, starting off, just conventional financing in general. When you're looking at conventional financing, you have to kind of play within the rules of the bank. And the bank can be a little bit difficult to work with depending on how you're going to source your down payment. So we wanted to just talk about starting with commercial financing. So commercial financing, we have essentially two different types of commercial financing that we're going to focus on. The first is going to be your large multifamily financing. So this is just building usually 5 units and up, and that is strictly residential real estate. Most lenders will offer between 75 to 80% loan to value on the property, depending on how it's servicing the debt. Most lenders are more in the 75% range than the 80% range.
I think one important thing to talk about on the residential side specifically is just sourcing of down payment, because it's a pretty big misconception. Everyone talks about, the 90-day history and having to have those funds for 90 days, and we often get questions like, well, I haven't had this money for 90 days, I got to wait another maybe month or two depending on it. And it's not having to have that money in your bank account for 90 days. It's just being able to show the history of where that money came from over the course of 90 days. So if that money came from a paycheck that you put into your RSP account or a TFSA account, and then a month or two later you were pulling that funds back out, that money wasn't in your TFSA for 90 days, and it's not going to be in your bank account for 90 days. But what we can show is over the course of that 90 days, you had a paycheck come in, you put that deposit into your TFSA, now you're pulling that back out. So we can show where that money's been over the 90 days. And really what they're looking for is just, is there any unknown source of funds, especially large deposits that coming in that could trigger some sort of AML or anti-money laundering issues with the bank. So they're just making sure that the sources aren't coming from illicit areas. It is your own resources, and they're really just trying to get a sense of where the funds are coming from. Now it can get a little document heavy depending on where your funds are coming from. So if you're pulling funds out of an RSP, there are some lenders who may ask for a 90-day history of that RSP account, and then just wanting to see the funds transferred and taken out and put into your checking account or whatever account they're going to be coming out of. So just keep in mind when we're asking you for all these documents, we're just following the bank's procedures. This is what we need to get done to be able to satisfy that condition and make sure that you're going to be good to close on your mortgage. Gifted funds, again, the same thing. It doesn't have to be in your account for 90 days. If you're getting funds gifted from your parents, we'll usually have a gift letter signed on, typically it's a letterhead of the bank. Again, just stating those funds, and they're just going to want to see those funds deposited into the borrower's bank account, making sure that those funds are there and ready to be moved forward with.
Yeah, Aaron's completely correct. We don't enjoy asking you for 1,700 documents, but unfortunately the bank does require we source the down payment history. And it's probably one of the largest hurdles that we have when qualifying some of our borrowers, is because if you have, say, 3 different investment accounts between you and your wife, and you have a TFSA account, you have your personal checking account, you guys have separate checking accounts, and you start moving a bunch of money around, and it's called money shuffling, it can get very onerous to have 3 months history on every single account you have. And then we have to break down each transaction, where it came from, the date, take a look at 3 months history on when that transacted into another account. it very soon becomes an onerous task to be able to track your down payment source. So word of advice, if you understand you have a purchase that's closing in like 90 days from now, try not to shuffle all your money around, because it's going to cause you a little bit of stress having to get the documents. We don't enjoy having to request all these documents from you, but please be aware you are going to have to get them for the bank to be able to prove your down payment source.
Yeah, and most residential lenders too, it's usually deposits over $2,000 or $2,500. So, even moving small amounts of cash around, if they want to ask for that history and it's just coming from your savings account, you're gonna have to show the whole 90 days. So like Josh said, like money shuffling, try to avoid it as little as possible. Put money into one account, leave it there. That'll make things a lot simpler moving forwards.
When you're looking to source a down payment for multifamily property, the bank usually allows you to source funds from your own means. So you can pull from a home equity line of credit, you can source it from your own down payment fund. So if you have just saved funds from a TFSA, or if you sold some stocks, you can show proof that you own those stocks, as well as you can actually get a gift from a family member as well. So when you're looking at qualifying conventionally, most people need to find it from their own sources.
Yeah, and I think some people don't actually know that you can still get gifted funds on the commercial side. So, I've had some clients, I'm sure Josh has as well too, where 50% or a decent amount of the down payment was borrowed from family. Popular from a lot of investors that are coming from overseas, just family money that they're able to borrow. And I mean, on the commercial side, it's a large down payment. So having the ability to be able to borrow that or have gifted funds from a family member, definitely helps with your cash reserves going towards the down payment for the property. The down payment is often determined by the debt service coverage ratio. So one of the main factors that we look at when we're running the numbers is that DSCR, and what we're looking at is basically the ratio of net operating income after expenses versus your annualized mortgage payments. One of the ways to get that ratio lower is just decreasing the amount of mortgage you're actually borrowing and reducing that expense. So if you're buying a property and it's debt servicing at 1.13, and where most lenders can probably work with a 1.15, you may not be able to increase the net operating income right away, but just reducing your amount of mortgage payment, increasing your down payment, is going to help that property debt service. So, one of the biggest issues we're dealing with right now in the multi-unit space is just the disconnect between the purchase price and the amount of actual rental income coming in on these properties. Most of them haven't had rental increases in 10 years in some cases, so it's just, it's out of proportion. The two options the borrowers have right now are to either go private, or if they're super liquid, put 40-50% down and really reduce the amount of debt you're taking on to help on that net operating income and that overall DSCR. So down payment has a huge effect in the overall qualification of the building as well too.
Yeah, and when you're looking at retail space, it's a little bit different than actual residential multifamily space. So most lenders are going to have a reduced loan to value when it comes to issuing you a first position mortgage, just because their risk tolerance for retail, especially right now, is heightened. Anything that isn't like a Class A tenant, or isn't like a McDonald's, or isn't a Starbucks, it's very challenging for them to predict the revenue that they're going to be able to generate, especially for all those mom and pop shops, salons, nail places, a lot of those places that kind of rent out those strip malls or those retail places. They got hit pretty hard with COVID, so the banks are more apprehensive right now to go high loan to value. Most of them are capping it at around 65%. Really cool thing about conventional commercial financing, though, is you can actually use a vendor take back and work it into your ratios as long as it debt services the loan. So we don't see it too often because the majority of investors are buying underperforming assets and not turnkey assets. But if you were to buy a turnkey asset that was operating at a high enough level, you could actually get a vendor take back from the seller, work it in your ratios, and reduce your overall down payment. But it only works if you have a property that's operating at a high enough level.
Right.
Yeah, and just like to touch on that too, they're not going to allow you to do the whole down payment from a vendor take back. You're probably looking at around a 10 to 15%. They're still going to want some cash coming from the borrower, similar to on the like any deal really. They want you to have some money then in your own skin in the game. So you're not going to get a full 25% VTB not to put any money in. Even the commercial conventional lenders are going to want you to have some funds in the game. Jumping over to the next topic here is obviously on the residential side. Starting off with just the basic insured deals. So, most people may know, I think by now, but you can get a multi-unit residential deal on the insured side if it is owner occupied. So if you're looking at a 1 to 2 unit building, it's 5% down minimum. And then if you're looking at a 3 to 4 unit building, it's minimum 10% down. Insurable is a situation where there is still, a CMHC or other insurance product involved in the file. Sometimes it can be back-end paid by the lender themselves, so it just helps to keep the risk low on the lender's behalf and still is able to get the client, one of the lower rates on the market. That goes up to a 35% down payment, so you can actually get up to 65% loan to value and still be able to capture those rock bottom rates, but still have that insured product. And then your basic uninsured is that 20% down or greater. This is going to get you your higher amortizations. You're going to be in that 30-year AM up to 35 years, sometimes even on the B side. You're still going to have really good competitive rates, but it's not going to be as low as what your insured rates are, just due to not having that insurance premium.
Yeah, something to keep in mind is your loan to value is also going to be dictated by your debt servicing ratios, but these debt servicing ratios are focused on your personal debt servicing ratios. So how much income to debt you have. So, the maximum loan to value is going to be 80%, but if you don't have enough income to support 80%, you're going to have to increase your down payment with a conventional lender to ensure that your ratios are in line. Or if that doesn't work, then you move on to an alternative lender that have higher GDS and TDS ratios to help qualify. But unfortunately, your loan to value is still dictated by your total revenue you can show on paper to prove to a lender. One really cool thing that most investors use also is your home equity line of credit. So as we spoke about with commercial mortgages, you can also do this with residential mortgages. So a lot of people will source their down payment from their personal residence to buy a rental property. Great strategy. A lot of people don't have that much liquid funds to be able to usually go buy another property, so this is a great way to be able to do it. But something to keep in mind is you have to personally debt service that debt now. So say you wanted to pull $100,000 from your line of credit, we could amortize out that debt. So what we do is we'll take the $100,000 as a liability, we'll amortize it out over 25 years with a 5.25% rate, which is the qualification rate currently, and that'll give us your monthly payment. And that monthly payment needs to be debt service within your ratios for you to be able to use that as a down payment source for your next mortgage. So depending on what your personal income looks like, it could be a challenge for you to source your down payment that way, but a lot of investors do use that strategy to be able to purchase other houses. This is one of the disadvantages of purchasing with a residential product or with a regular conventional product, is because if you don't have enough income on your file, it's going to be challenging for you to source that next down payment. But if you are using a commercial product, you don't necessarily need to service that down payment for you to be able to purchase that next rental property. So as you can see, if you start taking a look at the different products in the market and how essentially it fits with your specific situation, some products are going to be more advantageous for an investor than others, because sometimes investors just don't show enough income on paper to qualify. And that's why it's really important to understand the distinction between the two products and how they're going to help you guys scale.
Yeah, and I think something else to talk about too is each type of different residential lender has their own amount of minimum resources they want to come from your own too. So on the A side, if you're getting, if you're doing a rental property, there's some lenders who may not allow you to borrow or be gifted any funds for the down payment. They're going to want that to come from your own resources. So they may allow you to pull it from your HELOC, but for the most part, they're going to want it to come from your own savings, not a gift from your parents. When you get to the B side of the financing, they are a lot more flexible as to where that down payment comes from. So maybe some lenders want 5% minimum from your own resources. That could be your own savings, a HELOC. They'll also allow you to borrow it off of an unsecured line of credit as well too. So again, similar to the HELOC, we have to be able to debt service that payment. So with an unsecured line of credit, it's going to be 3% of whatever that balance is. So making sure that we can factor that in. And then there are some lenders on the B side too who allow you to be gifted the entire funds to be able to get that done. So depending on which lender you're going with and where you can qualify, because every lender kind of has their own underwriting. You may be on the B side or the A side, depending on how much of your funds you need to be, if you're getting funds gifted from your parents, that could determine what type of lender you're going to work with as well.
Yeah, and down payment is probably the largest hurdle that most investors come to us with. You either can't source it, you don't have enough of it, you're confused about how much you need. There's a lot of unknown about it, so we sometimes move it to more creative solutions, and that gets into the private solutions. So how does that work? Well, depending on the lender, most of these lenders are equity-based lenders, so they don't necessarily focus your qualification on your personal income and how much income you make compared to debt. They're more focused on their equity position in your property. The majority of these lenders need at least 20% down, between 25 to 20% down, depending on the location, depending on the condition of the property, and depending on your ability to be able to obviously complete the transaction. The better relationship you have with your lender, probably the higher loan to value you're going to have. So creating that relationship with your lender and your broker is going to allow you to possibly have a higher loan to value in certain situations. So for regular residential real estate, you're probably looking between 75 to 80% loan to value. For retail, you're also looking at probably a reduced loan to value, the same with conventional commercial lenders, probably 65, 70% depending on the area. Land can be tricky. Land is usually priced in the private market between 50 to 60% loan to value, specifically because it's all about marketability. If I'm a private lender, I'm stuck with a piece of land, like how fast am I going to be able to liquidate that piece of land? It really comes down to a specific buyer who has a vision for that. So, the loan to value is usually reduced on something like that. Agriculture is usually between 65 and 70% as well, just because there are only a handful of people in the market who are looking to purchase that amount of land, especially if it's tileable or if it's not. Can you work that land? Is there revenue that you could generate from it? It's a little bit more risk from a private lending perspective, but sourcing down payment with private financing doesn't have the same hurdles as regular conventional financing does. They're more concerned about their equity position and less on how you went about sourcing the funds for your project. A lot of investors will utilize this type of financing to be able to acquire a project or to be able to buy an underperforming multifamily asset. And then once your vision has been executed, so whether you've turned over the building or whether you have finished the build or whatever that might look like, then you move into that conventional piece of financing. So it's a great tool to have, usually a little bit higher loan to value, usually a little bit more costly when it comes to acquisition, but it's a very integral tool when it comes to investors being able to scale their portfolios.
All right, thanks guys. Really appreciate you breaking down for everyone at home exactly what to expect when it comes to figuring out your down payment on a potential purchase. Now again, obviously there's no silver bullet. There's not a one-size-fits-all answer here when we're thinking about exactly how to or what to expect when it comes to the down payment. It's really important that if you guys are getting into a more unique transaction, that you reach out to Josh and Ehren with plenty of time. So we've got all their contact information in the video description down below. Again, it's really better to understand what you're getting into in advance so you can kind of prepare and set yourself up for success, as Josh and Ehren were mentioning, rather than just kind of panicking and figuring everything out at the last hour, because that's how a lot of us real estate investors leave things too, is just kind of procrastination, and ends up just creating a lot more stress and unnecessary, angst and energy around the whole transaction. So again, it's really important to understand what resources do you got, what sort of deal are you trying to actually execute on, and then finally just understanding what type of lenders are out there and what sort of breadth and depth of different requirements or restrictions might they have when it comes to your down payment. Again, really appreciate it, guys.